and of course potential home buyers, this video is going to be very important for you. So it's about that dirty acronym called PMI, otherwise known as private mortgage insurance. It's basically on any conventional loan when you place less than 20% down. What this PMI essentially is, it's not an insurance to benefit you, it's actually an insurance to benefit Fannie Mae, Freddie Mac, or any end lender when home buyers are putting less than 20% down. If you were to, God forbid, default on your mortgage, this extra payment every month in the form of PMI mitigates the risk for that lender. Now, PMI is essentially assessed on 3 different factors based on how much of a loan you borrow, your size of down payment, so it'll be less to 5, 10, 15%, and your credit score, of course. So what you want to do is you want to really make sure your credit is pristine, and you want to see if you can put down as much as you can to get to that 20%, right? How that's assessed is between 0.5 to 1% of your loan amount. So I want you to think about it is, if you have great credit and you're putting down 10%, you're typically going to be right between 0.5 and 0.6. You take the amount you're going to finance, not what you're purchasing. So if you buy a $100,000 home, you put down 10%, you're financing $90,000. Times that by 0.6, divided by 12, that's your monthly PMI in most cases. Now, the biggest question I get is, does it make sense for us to put 20% down, Amir? Here's what I'll say. It's like a snowflake. Everybody is different. In some cases, it makes sense to keep the cash, not put the 20% down, if you can comfortably afford your mortgage payment. Lastly, does PMI follow you everywhere you go? No. PMI can be eliminated in 2 ways. Number 1 is if you're making your payments, well, by the time you hit to that 78th percentile, it should automatically drop off. That should be in your closing documents. So what does that mean? If you put down in a $100,000 example 10% and you're financing 90% of your home's value, by the time you get to a $78,000 mortgage, it automatically drops off in most cases. Secondly is a lot of people refinance. So their home value will go up based on market conditions, or they'll do some home improvement, now their home is worth more. You can get a new appraisal and essentially prove that you have 20% equity and you can remove the PMI, okay? So it doesn't carry everywhere you go. Think about the numbers, see what makes sense. PMI is really not a dirty type of tactic, but it just has to be in place to mitigate the risk of the investors, okay? Run those numbers through with your mortgage lender, and I hope this helps. Talk to you soon.